Joining me now is Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle. And Jeff, it's great to have you on. Let's start right there, because we've been talking so much about gold, and certainly gold has been kind of the pinnacle here, but what is moving the metals?
Well, I think there's three factors driving it. One is de-dollarization, and it started with the China block in Russia. I want to point out that the central banks now own 27% of their reserves are now in gold. It exceeds U.S. Treasury. So the de-dollarization theme, been in place for 5+ years, continuing to drive gold. Then we can add in the debasement trade, which really started to gain steam with the government shutdown. We saw the ETF have 110 tons of inflows in recently around the debasement. And then the third one, I'd just say diversification. Investors want to own something other than really, tight credit spreads in the fixed income space. And hey, you look at equity markets, they're kind of stretched. So metals, and I'd throw in copper, silver, platinum, palladium, the entire list you just rambled off. We're seeing it in all of these hard metals, and I think there's a lot more upside. I'm not going to say this thing won't trade down if we end the government shutdown, but we look out. To give you an idea, central bank holdings going back into the 70s, we're running at 75%. So if they're at 27%, we could see these numbers go much higher.
So you're an individual investor. You're watching. You're tuning in at home. How do you actually invest in this? Do you invest into the hard commodities, or do you play ETFs, something else?
I think the ETF is an excellent way to play it, because it's one of the few ETFs in commodities where you actually own the physical. You get to own the physical bars. And I think with gold in particular, investors want to know that they have access to the real physical. And that's one way in which you can get that exposure.
The industrial metals, is it a similar situation to what you just outlined with gold and the other precious metals? Or is this a reindustrialization? Is it trade dynamics? Is it tariffs? Is it other things, supply and demand there that's propelling that?
It's all of the above. In fact, I like to say copper is like a perfect storm. Gold and copper were our big picks a year ago. We still remain very positive on it. You look at copper, it's up nearly 25% year to date. It has that long-term underinvestment thesis that all the commodities are experiencing. Then you've introduced two unexpected demand surges, AI with the data centers, and then the second one is defense-related demand. And that's on top of the electrification. The electrification story, we coined the term, copper is the new oil. Because it's strategically the most important commodity if we're going to electrify the world. And then to make it a perfect storm, three of the biggest mines in the world, Grasberg in Indonesia, Escondido in Chile, and then Kamoa-Kakula in the DRC, all running into problems. You've lost about 500,000 tons of supply right now. So the market's in a deficit, flirting with all-time highs. We see a lot more upside from here.
Yeah, we just talked about it at the beginning of this conversation, but crude has not participated in this. What is moving crude right now, and is there a point at which that shifts and this becomes a broader commodity bull market?
Well, crude has been under pressure now for over a year around the enormous supply glut that everybody's been expecting. Well, that supply glut, or I'm going to call it a slug of oil, you can see it on the water now, but I want to emphasize it has had no impact on physical markets. Crude oil on the front end is backwardated. The spreads remain tight. You look at, refining margins, distillate cracks near an all-time high. So the bottom line is, that slug of oil people have been worried about, it's on the water right now, but it has not impacted prices. And I want to emphasize, if it was going to impact prices, it would have already impacted prices. The OPEC producers don't own that oil anymore. The consumers do. And the economics don't suggest they're going to store it. The economics suggest they're going to burn it in a refinery, given how wide refining margins is. And the forward curve does not pay to build the inventory. So more likely not, they're going to burn it. I think the main point here is this big concern around this big wave of supply. We're witnessing it. It's here right now, and we're not selling off. You're still sitting on $65, $66 a barrel on a Brent basis.